TheoTrade. This is Don Kaufman. October 28th, 2022. Just a few minutes left inside of the trading week. The S&P's up a blistering 90 handles and very much outside the volatility box. Look at this, trading all the way into the 39.11 handle. However, it's still all going to come down to the fact that, yeah, once again, you got a Fed meeting coming up this next week, and everybody is asking that question. Will this be, the pivotal Fed moment for the markets? That and much more here on this weekend update. Let's get right to work with a look at the S&P. So it's kind of what I call Breaking Bad outside the volatility box. For those of you, maybe you're a little new, maybe you haven't tuned in every single week and really every single day lately, I'm talking about the fact that we've been in an incredibly tight volatility box. Let me go ahead and highlight that here momentarily. The volatility box that I am referencing is literally from 3,600 to 3,800. So we popped outside the vol box kind of briefly, a brief and fleeting moment earlier in the week. But this one, this is big. This is definitive, and it's a vicious, vicious move to the upside. All right. So one of the reasons that the volatility box is so imperative to understand is it just has everything to do with the amount of gamma risk that is accumulated in here. What that basically means is, hey, look, if you don't necessarily, trade a lot of options, you got to realize that the S&P futures are in large part driven by option trades specific to products like SPX, products like SPY, products like VIX. Everything is already intertwined, and all of the open interest that you accumulate through time, if you're trading in the exact same range, what happens to some of the open interest? It just continues, okay, to amplify and amplify. And then when you're trading in that range for like a month, all of a sudden, eventually when you break range, you explode higher. Now, it doesn't necessarily discern that we're just going to be higher, but right now we have absolutely ripped to the upside of the vol box. Okay, why this matters at this point? Because you got to know, like, listen, where are we headed? Where are we headed? There are S&P levels that you need to know. And this is, I'm going to do this right up front here because you want to always be forward looking, again, into any of these weekend updates. It doesn't matter where we were throughout the course of this week. It matters right now where we're going, right? I mean, listen, the last couple of weeks, we've done nothing but ping like, right back and forth between 3,600 and 3,800. So here we are. Again, this happens to be a 90-day, 1-hour chart, but now I'm actually going to come down to 1 day, 1 minute, because you can see today's trading session opened right on the upper edge of the volatility box. The upper edge of the volatility box, to be really definitive, was somewhere right around that 3,800, 3,811. Even with all the negative earnings, which we'll talk about here momentarily, we still exploded. I mean, it ripped. And when it did rip, again, all the gamma risk came with it. So here we are trading again, just about 39.11. It is it is ugly. Again, we're outside that volatility box. Nevertheless, where are we likely to go? So a couple of key levels that are in play immediately. Just to the upside of this, we have what we term a gravity point. For those of you that are not aware, again, what a gravity point happens to be, this is going to be like, if you will, it's the warm, fuzzy place, okay, where risk goes to die in the marketplace. And again, I cannot stress this enough when I start talking about, the warm, fuzzy place over here. That right there happens to be none other than 39.31. That's 39.31. And again, that's the S&P futures. That's not the SPX. And a gravity point is, okay, this is an area we've identified. It's an area we've identified that is almost like a seam in terms of risk. Now, to kind of further this, for a conversation point, let's go to back to the 90-day, 1 hour. And if we take a look back through time, okay, this 39.31 is just, it's been a central point of trade. So that's the first stop along the way. Now, make no two ways about this. This 39.31, I mean, hey, look, we're hop, skip, and a jump. We're what? 20 handles off of it, 20 S&Ps handle off of it. So I think you have to assume, barring any unforeseen circumstances, even when we open up, for instance, on Sunday night And the futures trade, the futures may trade right into 39.31. Okay, great. So you got that level down. Next, to the upside, you break through 39.31. Okay, not a joke here. It's a straight shot. Okay, right back up to the next gravity point of 42.11. So 39.31 is pivotal. But one of the things that I always mention about these gravity points, when you hit a gravity point, you don't look at it necessarily as support and resistance. It's a point to which we are drawn to. And every time we hit one of these gravity points, it becomes a 50-50 at that point, whether we're going to trade higher or lower. And I can't stress that point enough, that this is a doorway. It's a doorway higher or doorway right back down. So for the most part, you got to hit that gravity point. Okay, we'll make some assessments thereafter. But again, you get above that gravity point, and we have a straight shot right back to 42.11 inside of the S&Ps. Now, of course, everybody wants to look to the dark side of the force over here, but I guess the question at this point is it going to be a shortable rally? We're going to come to that in just a couple of moments. All right, so upside levels, 39.31. And then, again, if we are able to sustain that and we get some momentum behind us, you're a straight shot up to 42.11. Okay, push that aside for just a second because, again, you've got the Fed coming, which we'll bring up in a moment. Before I get into the Fed, you got to look at the big, bad, and the ugly. Tech earnings, absolute slaughterhouse. One of the things that's pretty shocking about this particular rally, it's going on at, if you will, the most, odd time. Inopportune almost. I mean, you take a look at like Amazon, it got absolutely devastated. Don't worry, because the rest of the marketplace was up 2.5%. Amazon is recouping itself just to a degree. You take a look at Microsoft. It's like it never even happened. Well, no, it happened. Okay, Microsoft came off the 250 level, traded as low as what? 226, and it's rebounded. And it's rebounded significantly. Okay, but that still inflicted some serious damage. Looking down the list, some of the usual suspects. So we already covered a little bit about Amazon, Meta. Okay, it's a disaster. This one, it's not recovering. Okay, and I want to make something very clear about Meta because I was going to talk about this in a moment, but hey, perfect time to bring it up. There's 100 billion reasons to be concerned about tech. But when it comes to Meta, by the way, I call it 100 billion reasons because I had heard earlier in the week, 100 billion is approximately the hit that Zuck took throughout the course of this year. One thing that's worth pointing out, if you take a look at something like Meta, it's down 70% on a year-to-date basis. I've had a lot of emails, a lot of questions. Is this thing going to come back? Absolutely unequivocally not. At this point in time, this will be dead money. Period. I mean, this is, this is an absolute tech wreck. If you look back, even over the last 3 years, it's down 50% over the last 3 years. And even more appropriately, bringing up even a 5-year chart, you're still down almost 50% over the last 5 years. In fact, looking at some of the last 10 years, which does not include the full IPO, but again, it's fairly shocking the kind of move that we've actually incurred here, specific on Meta. But it all came down to, of course, this last earnings announcement. Nevertheless, that's one that I do not believe is coming back anytime soon. So the reason I'm bringing up tech earnings, we'd have to look down the list, of course, at Google. I mean, you're just trading down, and at the exact same time, we're propagating a significant rally. And one of the things I wanted to display on this particular front is to look over at spiders, okay, or even appropriately SPX. The SPX is going to actually close this week outside the expected move. So not only did we actually smash through the volatility box to 3,800 level, but the SPX, you realize you have two consecutive weeks outside the upper edge of the expected move. I mean, that's statistically, it's getting a little bit wild, right? Obviously, with the Fed announcement coming in again, the S&Ps are actually, they're rallying right now into this closing bell. So if that's true, okay, let's go take a look at the QQQ. If you look at the QQQ and bring up auto expected moves, one of the interesting things, the Nasdaq, which is pretty shocking, it rallied. Right, it's actually going to close up on the week, and again, it's not exactly hitting the upper edge of the expected move, but you're looking, if you will, at the demise of mega market capitalization. There's no question, Apple is still an absolute behemoth, and Apple is what has actually carried the S&Ps. Apple is what carried the rest of tech stocks. That's how much magnitude it basically has. Nevertheless, it's a disaster, okay, in terms of tech, and it looks like it's going to continue to be incredibly volatile. One of the questions you need to be asking yourself, again, which we're going to bring up here momentarily, is there some stuff to short? Well, I wanted to show you around for just a moment because, we just looked at big tech and so forth, and you're like, yeah, but the S&Ps are up huge on the week. How are the S&Ps up huge? Financials, that's number one. Take a look at the financials and auto expected moves. The financials have actually smashed through to a 2 deviation move to the upside. This is also the second consecutive week financials have been outside the expected move. The other major sector playing a role, okay, happens to be none other than the energy sector. The energy sector, okay, you were actually 1 week where we did 2 times the expected move. This week, it's actually closing just to the upper edge of the expected move in energy. So what sector takes the cake in the last 2 weeks of trade? Unequivocally, it is the financials, which is actually going to come up here. It's going to be on the test in just a few minutes. So just bear with me on that front. Okay. I'm just looking at this as I bring you guys into, again, a little bit more scope. Anyway, onward and upward over there. The next, obviously, that we're going to discuss here on this weekend's update is none other than, well, we have a Fed meeting coming up. I just want to bring up the calendar. Okay, well, here we go. Advanced decline line. Look at that. We're pegged total correlation in there. Bringing this up in the calendar. Of course, we're actually going to drop into next week. Yeah, once again, okay, the Fed is coming out. So the Fed announcement, Fed conference. One of the reasons I'm bringing this up, it's, everybody's like, hey, listen, this is exactly what's going to happen. But this is kind of the meeting that, I don't think this meeting is necessarily as pivotal as last meeting, but here's the whole key to this next meeting, right? This is the pivotal Fed moment. We're actually going to find out if they're going to talk about cooling off some of the interest rate hikes. And that has been a lot of question. That's, of course, the title over here. And if you take a look at this in the probabilities actually kind of cooling off a little bit, just a little bit for the 75 basis point hike. And again, I want to bring this to everybody's attention because this number has actually come down. If you looked earlier in the week, I mean, this thing was basically like, 98% chance of a 75 basis point hike. It's come all the way off to about 81%. So it is definitely on the move. It's basically what we're saying is, hey, it's not written in stone that we're going to have a 75 basis point hike. And if we were to turn around and only have a 50 basis point hike, do you realize that's why I'm talking about 42.11? You're like, 42.11, are you crazy? Okay, yeah, just crazy enough that the Fed only raised 50 basis points. Okay, you're going to be sitting at 42.11. The other thing you have to rationalize here, the Fed is notorious for going, double down dove. They haven't been lately because obviously they want to stamp out inflation as fast as possible. But I have my reservations at this point because they might be looking at this and thinking damage is inflicted. Let's come to the closing bell. All right, so the Fed is obviously, inflicted a considerable amount of damage, and they're probably extraordinarily aware of that. And again, I do have my reservations. Again, keep your hands and feet inside of the vehicle during that FOMC announcement. The reason that I was thinking about this is GDP was great. Okay, that's supposed to say durable goods. Okay, durable goods, an absolute disaster, and PCE, which is that's actually what they would call like the Fed's favorite number. So GDP was actually really good. The GDP, if you will, kind of got sandbagged a little bit into Q3. Like, I just don't like being the economist over here. Durable goods sucked. Okay, it was a disaster, and the PCE came in as expected. So the reason I'm throwing this up here is, I got more questions than answers in this front, because if you look, at those three, they're all over the place. And then the jobs number came in, and, the jobs number, it's really good, but not that bad. And, we're all over the place. Again, it's my estimation that the Fed actually remains strong and stays at a 75 basis point hike. But the key to the entire meeting, again, are they actually going to talk about cooling off in terms of not cooling off to lower rates? They're not going to totally pivot, but they are going to start to cool some of the hikes. And that is what could actually spark the conversation piece inside not only the marketplace, but, if you think there's a rally, listen, I believe that that's what this rally is about. That the marketplace believes that the Fed is making that pivotal moment in the markets where they're going to say, hey, 75 basis points, but next time you're going to get lucky and it's only going to be 50 basis points. You got to realize what we're doing here. This is going to be the fourth hike at 75 basis points. It's like driving 100 miles an hour looking through the rearview mirror. It's all backward-looking data, and that's the point I was making with GDP. GDP got sandbagged again. Durable goods, disaster, PCE. Okay, they got no clue what's in store for them, even 3 months out, and they're hiking at just a ridiculously fast rate. So again, my idea over here: short something. more of a question, but I'm actually comfortable doing just this. So we've had kind of a blistering rally at this point. We've recently come off, like, listen, this is a reactionary low at 3,500, but if you're looking at the marketplace, 3,600 is straight shot up to 3,900, right? So a 300 point, rally has actually ensued in the marketplace. So what to do now? So I like to actually construct a couple of trades around this. One of the first things, I'll tell you exactly what I did today. I went out in the S&Ps, sold some way out of the money call premium. So when I say way out of the money call premium, yeah, I'm not joking. I sold some way out of the money call premium here inside of the S&P options on futures. Pretty negligible amounts of margin tied up in that. That's one trade that I did. Another trade I actually went and did was on like Goldman Sachs. Okay, why Goldman Sachs? Well, I picked on Goldman Sachs specifically because if you take a look at auto expected moves here, smashed the upside of expected move last week, smashed expected move this week. 2 weeks in a row, I felt this was actually, quote unquote, shortable. So I used an in-out spread, one strike in the money, one strike out of the money. It's a pure directional bias, looking for a pullback in the next 21 days. The last thing that I actually did throughout the course of the week, I also put on a flyby. This is a 1-3-2 ratio butterfly. And this one, okay, it's even slightly in the money, Okay, have no fear, the flyby ratio butterfly, right? And what does that actually look like? Come over to buy. Okay, you do something like deep and wide. You got to love this. 1 month, 2 strike, unbalanced butterfly. Oh, there it is. Okay. And it's a 126, 128, 130 spread. Now you can put it on for about a 60-cent credit. I didn't collect quite that much, but it's a 1x3x2 trade. So you have at it 21 days to sweat that marketplace out. So again, I'm looking at stuff like in JP Morgan. I looked at which is a flyby, Goldman Sachs, which is just a bearish put spread. It's an in-out spread, and of course selling S&P options on futures, which is very, very nominal margin, or even better yet, you can of course use the micro contract. So that's just a few ideas. Now, why did I go after the financials? I went after the financials because, again, it was the most blistering move to the upside, and I love rallies like this. Listen, I'm not here to try to time this market perfectly. As I showed you in a couple of the trades, I gave myself plenty of time to be right, plenty of time to be wrong. None of the positions need, this catastrophic move, either higher or lower. All I need is markets to either stall out or back off a little bit sometime in the next 3 weeks, and we're gold, Jerry. We're gold. Meanwhile, though, that financials, they are wild to the upside over here. Well, last thing that I do each and every weekend update, we talk, of course, about expected move, because expected move, this is what drives flow, people. Okay. I mean, look, in terms of the SPX, this is 2 consecutive weeks we've actually cracked, the upside. And again, if you look back at the last couple of weeks, the marketplace, this is where people go, oh, we're rallying back. There's one thing, though, that really should resonate with you. Yes, we're rallying back. Okay. But what should resonate with you on this front, it's not about going higher or lower. It's look at the screen for a second. Just look at the screen. Follow. Okay. Right there. Breach, a breach, a breach, a breach, a breach. Okay. A breach, a breach. So and again, I just zoomed in over here. That's 1, 2, 3, 4, 5, 6, 7 breaches. 7 breaches in the last, like, what? Okay. Here's a week that didn't breach. Here's a week that didn't. Here's a week that didn't. In the last, 10 weeks, 7 out of 10 breached the expected move. You do realize what expected move is. You're supposed to stay inside the line 68% of the time. The irony is 70% of the time right now we're breaching, which basically means if you're sitting here thinking to yourself like, oh, the volatility is dying down, okay, you would be dead wrong. The volatility is not dying down. We're still ripping apart at the seams, which brings me to the point. Again, we had about $114 expected move in this past week of trade. What are we estimating? And by the way, the expected move is not set for another 10 minutes, but what are we expecting the expected move to be, okay, just 7 days out? Okay, this is where we actually look right over here at the SPX. Okay, it's about $120. And you go, how can you possibly trust that? I'll tell you how you trust it. Okay, there's over 3 million contracts that just traded in the SPX today. 3 million contracts. Now, the entire marketplace may do 50 million contracts, but this is 3 million contracts of almost a $4,000 product. You take a look at the spiders, and the spiders basically the exact same thing as the SPX. Guess what? The spiders did 9 million contracts. Now you're up to 12 million contracts. Okay, which is, again, it's like a quarter of all contract size that even trades in this entire business. is all predicated on one product, the S&P. By the way, you can include the VIX in there, the QQQ. It all correlates into, of course, the S&P 500. That is $120 expected move. I got to tell you, when you're moving $93 today, how can the entire next week of trade only be $120? Do not sell short-dated options. That's what it's telling you. Don't sell short-dated options. In the short duration, you'd rather be a buyer of options. In the longer duration, where there's some skew, okay, you can go out and sell some premium. With that, again, okay, be on it with those levels. You got to keep in mind, right? What? 39.31, 42.11. To the downside, listen, if we do start to go back down again, right, it would be the abyss. And the abyss it would be a precipitous drop back into the volatility box. We'll reassess after that. Do not be surprised to see us, okay, throughout the course of the week and the possibility of dropping back into the volatility box. But right now, we've got explosive gamma to the upside, okay? And we're right on course for that 39.31. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.